All right, let's jump right into our deep dive, looking at dividend stocks for 2025. We've got some really interesting stuff to cover today. An article that highlights some top picks for this year, and then we're going to take it a step further and really dig into those companies to see if they actually live up to all the hype. One thing I'm particularly curious about is, how these stocks measure up, especially considering the S&P 500. It just had this incredible 53.2% jump between 2023 and 2024.
Yeah, that's a great point, with the market performing like that. Some investors might be thinking, why even bother with dividend stocks? But the reality is they offer something completely different. It's not about chasing those, rapid gains that you see in a bull market. Dividend stocks are more about that steady, reliable stream of income. It's about that stability, especially, when things inevitably take a downturn.
Yeah, that's an important distinction. So instead of, constantly trying to time the market or catch those big swings, you're saying dividend stocks are more like having a steady, reliable friend in your portfolio.
Exactly. And that peace of mind, can be priceless, especially if you're looking for ways to generate some passive income.
Okay, so let's meet our first potential friend here, Honeywell International. Now, what really caught my attention with Honeywell is that they're involved in so many different things. You've got aerospace tech, building automation, energy solutions. Heck, they even make those smart thermostats I have in my house. But are they a good investment?
Well, let's take a look. Their track record is pretty solid. They've actually increased their dividend for 14 years straight now, which is really a sign of commitment to their investors. And their current yield sits at 2%, which beats both the S&P 500 and the average for the industrial sector. So, not bad at all.
That does sound promising. Yeah. But I have to ask, with all this diversification, are they truly excelling in any particular area? What's the real story behind their success?
Well, that's where things get a little interesting. While they're definitely a tech-focused company, their earnings growth hasn't been anything spectacular. They've relied pretty heavily on acquisitions to boost those numbers, which isn't always the most sustainable strategy. And that's led to them taking on more debt.
That makes me think of those companies that just buy up a bunch of smaller companies.
Yeah.
And hope that, something sticks. Not always the recipe for long-term success.
Right, and there's another layer of complexity here. Honeywell is actually considering spinning off their aerospace division. Now, that could unlock some value for shareholders, but it also injects a certain level of uncertainty.
So maybe not a sure thing then.
Well, it depends. If you believe in their long-term vision and their ability to really innovate, there could be some potential. But it's definitely a stock for those investors who are comfortable with a bit more risk.
Okay, so maybe not that set it and forget it type of stock. Let's switch gears a little bit and talk about American Electric Power, or AEP. Now they seem like the epitome of stability. A classic utility company, right?
You could say that. Their dividend history is truly impressive. They've got 114 years of quarterly payments under their belt, and they've been consistently increasing that dividend, which, signals confidence in their future. And on top of that, they're boasting a 4% yield, significantly higher than Honeywell's.
Wow, 114 years. That's almost as old as my great-grandmother. What's their secret?
Well, part of it is the nature of their business. They operate in regulated markets, which provides much more predictable returns. And with the rise of data centers and all this, AI boom, they're seeing increased commercial sales, which is definitely a positive sign.
So are we talking set it, forget it stock now?
Right.
Buy it and just watch those dividends roll in?
While their history definitely suggests stability, no investment is entirely risk-free. I think it's always wise to keep an eye on factors that might impact their future earnings, things like potential changes in regulations or shifts in energy consumption patterns.
Fair enough. Always good to stay informed. Now for our final pick, let's move away from individual stocks and look at an ETF, specifically the Energy Select Sector SPDR Fund, ticker symbol XLE. This one invests in a basket of energy companies, which I think is pretty intriguing, given all the changes that are happening in the energy sector right now.
Yeah, and it's currently offering a respectable 3.3% dividend yield. But what I think is really interesting here is the composition of this ETF. It's heavily weighted towards oil and gas giants like Chevron. So to really understand the potential here, we need to look at metrics like the price-to-free cash flow ratio. For example, Chevron's ratio tells us that they are generating a good amount of cash compared to their stock price.
So does that mean they're likely to continue paying those dividends and maybe even increase them in the future?
It's certainly a positive indicator. And remember, with XLE, you're getting exposure to multiple companies like Chevron. with potentially strong cash flows. It offers that diversification within a sector that's experiencing some pretty significant tailwinds.
Okay, so we've got three very different options here, each with its own set of pros and cons. It seems like we need to think carefully about which one aligns best with our own individual risk tolerance and investment goals.
Absolutely. There's no one-size-fits-all answer when it comes to investing.
Yeah.
It really is. And, even within the world of dividend stocks, it's fascinating to see how these different companies are approaching growth. Take Honeywell, for example. Their big push into the industrial Internet of Things, or IIoT, is a pretty bold move.
Okay, break that down for me a little bit. What exactly is the IIoT?
Sure. So think of it as connecting all those industrial machines and systems to the internet. So this creates, just a flood of data that can be analyzed and used to really optimize everything from production efficiency to, even energy consumption.
So it's like taking those kind of old school industrial processes and giving them a digital makeover. And Honeywell is right in the thick of it.
Absolutely. They're investing heavily in software and analytics. They're even using IoT technologies to streamline their own operations.
That makes me wonder, though, could this focus on, kind of future tech be a reason why their recent earnings growth has been a bit underwhelming? Are they sacrificing short-term profits for a long-term bet?
Yeah, that's definitely a possibility. Transforming a company the size of Honeywell, it takes time and resources. And investors who buy into this vision, they need to be patient and understand that the payoff might be years down the road.
That makes sense. Sometimes the most innovative companies aren't always the best short-term performers. It's really about seeing that bigger picture. Speaking of the long game, let's circle back to American Electric Power for a second. That 114-year dividend history is just incredible. It tells me they must be doing something right, especially when it comes to, managing their finances, navigating those economic storms.
Absolutely. I mean, their track record really speaks volumes about their commitment to their shareholders and their ability to adapt to those changing market conditions. At the end of the day, people always need electricity, regardless of what the stock market's doing.
But even with that in mind, I'm curious how they're approaching the shift toward renewable energy sources. And, a cleaner grid. That has to be a major consideration for any utility company these days, right?
It absolutely is. And to AEP's credit, they are investing in renewable energy projects and grid modernization initiatives. They're not just, clinging to the past. They're recognizing the need to evolve.
That's reassuring.
Yeah.
But even if they're adapting, can a traditional utility company like AEP really achieve significant growth in the coming years? It seems like a tough industry to generate those, explosive gains.
You're right. Utility companies aren't typically known for their rapid growth. But remember, AEP is benefiting from that surge in data centers and that increasing demand for computing power. That's a trend that's likely to continue, and AEP is well-positioned to capitalize on it.
So while their growth may not be as flashy as, say, a tech company, it could be more sustainable and predictable over the long term. It's a different kind of growth story.
Exactly, and it highlights the importance of understanding the specific dynamics of different industries when you're making those investment decisions.
Okay, let's shift our focus back to the energy sector and that XLE ETF. You mentioned the price to free cash flow ratio as a key metric for evaluating energy companies. But what else should investors consider when they're looking at an ETF like this?
Well, as we talked about earlier, the composition of the ETF is really crucial. Which companies are they holding? What are their individual outlooks? You don't want to just blindly invest in an ETF without understanding those underlying holdings.
So even with the diversification that an ETF provides, we still need to do our due diligence on the individual components.
Right. And you also want to pay attention to the ETF's expense ratio, which is basically the annual fee that's charged by the fund manager. A lower expense ratio means that more of your returns are going to stay in your pocket.
Simple enough. Lower expenses, higher returns. But with so many ETFs out there, how do we even begin to narrow down the choices?
Well, that's where your individual investment goals and risk tolerance come into play. Are you looking for, long-term growth and income? Do you believe in the future of the energy sector? If so, XLE might be a good fit. But if you're more risk-averse or have a shorter time horizon, you might want to consider other options.
It seems like the key takeaway here is that there's no one-size-fits-all approach. It's all about finding the right investments that match your specific needs and circumstances.
Yeah, it really does feel like we've uncovered a treasure trove of information on these dividend stocks,
Wow.
from Honeywell's, tech ambitions
Right.
to AEP's steady reliability and that diversified approach of the XLE energy ETF. We've explored a lot of ground.
We have, and I hope you're starting to see that dividend investing isn't just for a certain type of investor. It's about, building a portfolio that generates that consistent income and it aligns with your individual goals and your risk appetite. Absolutely. But before we wrap up this deep dive, there's one more question that's been kind of swirling around in my mind. We've talked about, the appeal of dividend stocks for income and stability. But what about growth? Can these companies also deliver, significant appreciation in their stock price over time?
That's a great question, and one that I think challenges the common perception that dividend stocks are only for those conservative investors. The truth is, some dividend-paying companies can achieve really impressive growth. It's about finding the ones that are innovating, adapting to change, and really positioning themselves for a successful future.
So it's not an either situation. You can potentially have both income and growth within a dividend-focused portfolio.
Exactly. It's about looking beyond just that dividend yield and really understanding the company's underlying business, their competitive advantages, and their long-term growth potential.
This has been a really eye-opening journey into the world of dividend stocks. We've learned that there's a whole spectrum of options out there, each with its own story to tell. Honeywell with its forward-looking tech bets, American Electric Power with its legacy of stability, and XLE, providing that diversified play on the energy sector. It's clear that there's no one-size-fits-all approach.
No, there isn't. The key takeaway here is to really do your research, understand your own risk tolerance, and never stop learning. The world of finance is constantly evolving, and staying informed is the best way to make those smart investment decisions.
Well said. And on that note, we'll leave you with one final thought to ponder. As you continue to explore these dividend stocks, think about those long-term trends that are shaping the industries and the companies that you're considering. Are they embracing innovation? Are they adapting to change? Are they positioning themselves for a successful future? These questions, I think, will guide you towards investments that truly align with your vision and goals.
Happy investing.
And until next time, keep diving deep.